One concern would be that central banks, having been too dovish early on in terms of not raising rates, not shrinking their balance sheets fast enough, that as inflation is coming down, and I think they have air cover, that they're going to be patient because they don't want to be too quick this time to stimulate things, to bring rates down. And so I think we could see a little more of a slowdown. That's a possible risk out there. As investors, it's interesting. I would say one of the things I worry about is that we wait too long, particularly in some of the sectors where there's been a bigger decline in value and people are more cautious. So we had a meeting this week with our growth equity team, and we were talking about some of the opportunities in that space. A lot of investors are obviously cautious there. Commercial real estate, which I'm sure we'll talk about, the sentiment has gotten quite negative and the fundamentals feel like they're bottoming. So I think as investors, sometimes one of the risks is you miss it by being overly cautious. And I think now is probably a good time before rates come down to move.
But move on what? And again, do you have an allocated capital that you want to try and get in as soon as you think,
There's no sort of specific, like, we have a budget to spend this much. It's just more directional. It's that, in fixed income, the spreads in a lot of asset classes are still wide by historic standards. Base rates are still pretty high, so that's a good area. Being a capital solution provider today, helping people get some liquidity makes sense. People who need to deleverage, working with the banks and giving them some capital relief. And then particularly in sectors where we have high conviction, in digital infrastructure, in green energy, in life sciences leaning in. So I would say it's pretty broad-based. And then specifically on real estate, definitely here in Europe, the sentiment's so negative, try to move faster.
And so, but are there opportunities actually in commercial real estate? And do you have to fight them off with some of your formidable competitors as well? Because now's the right time to get back in.
There are definitely opportunities. I would say the sentiment is more negative. The competition is not as great as normal. Real estate's obviously been hit by two big forces here. One, work from home, which has really hit the office sector. And the second is the rise in interest rate, which has caused cost of capital to go up and caused multiples in real estate to come down, cap rates to go up. And so what you want to do in this kind of environment is look through that, because that's occurred. There are going to be tons of headlines of market transactions that were priced in a different world that will run aground now. You'll read about them in banks, maybe insurance companies. But on the ground, we're seeing cost of capital start to come down. Spreads are starting to tighten, and new construction's coming down dramatically. So in sectors that we really like logistics, benefiting from e-commerce, digital infrastructure, student housing, hotels, we think there are opportunities, and we've done a number of multi-billion-dollar transactions.
But is there a danger that something goes under in the commercial real estate space that infects others, that could snowball into a systemic issue even?
I don't think it's systemic. I think there are financial institutions that have investments or loans that were made in a different period of time. And we've seen that most recently in New York Community Bank. And those institutions are going to have to mark those assets to market. Those loans will come due. There'll be needs for new capital. There may be some institutions who get into more trouble. I don't think this is like 08 and 09 in terms of the scale of what we were facing. But I do think there'll be some situations. But that's what creates the opportunity. It's because the perception is so negative. The headlines are negative, and yet the value decline has occurred. I'm not saying there's some V-shaped recovery, but when you get into this bottoming period, that's when you want to try to move.
So when you say getting into a situation, this is what companies actually going bust?
Well, there are definitely assets that were financed in a different area. Particularly, you focus on commercial real estate, because there's been a more profound impact, certainly in the office sector. And so I think that will create opportunities. We bought a $17 billion mortgage loan portfolio with the FDIC from Signature Bank. Those are the kind of opportunities. There may be more of those that emerge. But I think saying that this is going to lead to a much broader systemic issue, I think that would be too much.
I mean, there's growing competition, of course, in the asset management world for retail PE. How does that change how you do business?
Well, I think at the end of the day, if your customers are pension funds, sovereign wealth funds, insurance companies, or individual investors, at the end of the day, you have to deliver good returns. It's like a restaurant serving good food. And if you don't do that, the customer is going to go elsewhere. Now, the distribution format is different because you're not talking to a couple hundred customers, talking to a couple 100,000 customers. The structure of the vehicles can be a little bit different in terms of their liquidity, their yield, their tax structure. But to me, the end product is the same. And what we're trying to do is leverage the enormous scale and insights that Blackstone has in terms of what we see in the world, the people we have on the ground, and then generate more favorable returns. And then deliver that to different underlying customers. But it's, at the end of the day, really the same product.
But isn't it, in part, fundamentally changing the industry, or at least, the business model of some of your investors?
I do think the business is evolving. I mean, if you went back and you said, what was this business 10 or 20 years ago? It was private equity, real estate private equity, and opportunistic credit. You were seeking to get 20% gross returns, 15 net. And now what you're seeing is, as we've moved into some of these lower returning, longer duration vehicles, core plus real estate, infrastructure, performing credit, the universe of potential investors gets much larger. The universe of potential assets to invest in gets much larger. And so a firm like ours and some of our competitive firms have benefited and grown a lot in scale. I think the good news is we're still pretty early days in this process.